Hi guys, this is Andrew from Dividend Growth Masters, and today I wanted to talk about a pretty important topic, and it's something that should be on the mind of every dividend investor, and it's often on my mind as well. And that topic is dividend sustainability. That should be one of the first questions you ask before you invest in any dividend stock, because it really sucks when you're blindsided by a dividend cut. So let's talk about dividend sustainability. The first metric that we'll look at is the dividend payout ratio. As I mentioned before, dividend sustainability is very important. We never want to get caught holding a stock that cuts its dividend, because typically it drops by a lot. When General Electric cut their dividend not so long ago, from from 24 cents per share to 12 cents per share, their stock price cratered. And that's obviously not the kind of companies we want to be investing in. So there are basically two ratios that I want to talk about. You're probably pretty familiar with the first one. It's the dividend payout ratio. Dividend payout ratio measures how much of profits a company is paying out in dividends. As always, we want to be careful of companies that are paying out a significant portion of their profits as dividends. If earnings drop, say during a recession, the dividend may not be safe. In general, anything above an 80% dividend payout ratio is pretty high. The only exception is really for REITs, because they're obligated to pay out 90% of their profits as dividends. But other than that, if you see a really high dividend payout ratio, you should be more cautious in evaluating the earnings quality. Now, another metric that I like to use is a modified dividend payout ratio. I like to call it the cash payout ratio. So instead of comparing the dividends to net income, we're going to compare it to free cash flow. So free cash flow is calculated as cash from operations less capital expenditures, or CapEx. Now sometimes we want to use the cash payout ratio because there could be accounting items that impact the normal dividend payout ratio, which is net income. Now, if you're not that familiar between accounting and cash flow, net income is basically different from cash flow, despite what some people think. So under U.S. generally accepted accounting principles, net income tries to match the economic transactions that impact the company, and not necessarily when cash is received or exchanged. In contrast, cash flow just measures when cash was received or paid. For instance, if a company took a large write-down of an asset or some kind of legal charge, the profits would suffer, but those things really don't impact cash flow. So that can make the dividend payout ratio look more higher than it actually is. So both ratios have their purposes and should be used in conjunction with each other. The other thing I like to look at is leverage ratios. So leverage is really important to consider when you're investing in dividend stocks. That can be used as a tool to juice returns, but also it's a double-edged sword if things don't go so well. I've seen numerous companies cut dividends because their debt load becomes too high. So I use two primary ratios when looking at leverage. The first is debt to EBITDA, and EBITDA is just net income plus interest, taxes, depreciation, and amortization. So debt to EBITDA basically measures the amount of debt relative to earnings. In this case, earnings is measured as income before interest, taxes, depreciation, and amortization. So in general, a debt to EBITDA ratio of about 5x is pretty high, but the ratio will differ across different industries. So it's important to also consider that when you're comparing against peers. In general, you won't see very high leverage ratios in restaurant industries or retail stores, anything in the retail industry, but the ratio will be much higher with some industries like casinos. The other debt leverage ratio that I like to use is debt to equity, and this basically measures how much of assets is financed with equity. In general, a debt to equity ratio of 1.5x is pretty high for a dividend stock. Now, for the next few metrics that we're going to talk about, they're a little bit different than what you might traditionally consider when you're looking at dividend stocks. But the next one I want to talk about is dividend longevity. Now, I know you've probably heard this before, but they say past performance is no indicator of future performance, which, is a really common saying. However, I've seen more short-term dividend companies cut their dividend than I've seen long-term dividend payers cut theirs. So I think dividend longevity is pretty important to consider when it comes to dividend investing. In general, paying a dividend over multiple decades in economic cycles is very difficult to do. In fact, there's only a few companies that have ever been able to do that. So when you find one trading at a cheap valuation that has been able to do that, it might be considered adding to your portfolio. In general, I like to look for companies that have either paid and increased their dividends every year for at least 25 years. Something else to consider is industry cycles. This is something that's rarely considered in the minds of dividend investors. However, industry cycles can have a very dramatic impact on a company's abilities to pay dividends. Some industries are very cyclical. This means they go through big boom and bust cycles. During the boom years, the earnings grow pretty significantly, and they are able to pay out pretty big dividends. However, when demand weakens and the economy softens, the profits decline. And as a result, they might cut their dividends. One of the biggest cyclical industries is cars, the auto industry. Cars are primarily financed by credit, which itself goes through big boom and bust cycles. During the good years, car makers will often loosen their credit standards and car sales go through the roof. But when the economy weakens, during a recession, people bail out on their loans they're not able to pay, and the car companies lose a bunch of money. And this is a basic gist of what happened in 2008 2009 with some of the big automakers in the US. So if you ever invest in a cyclical stock like that, it's important to try to evaluate where you are in the economic cycle. And one metric to do this is basically valuation. In general, if we're closer to the peak of industry cycle, these stocks will have low earnings multiples. And this is because they're making the most amount of profit. In contrast, when we're near the low end, if we're near the low of an industry cycle, the stocks will have high valuation multiples because they won't be earning much. So the profits will be very low and the valuations will appear very high. The fifth thing to consider when it comes to dividend sustainability is earnings and cash flow. Ultimately, dividends are driven by profits. And if a company isn't generating any profits or increasing profits, it can't pay or increase its dividend. That's why I like to focus a lot on earnings and cash flow growth. In general, I like to see at least 5% earnings or cash flow growth over the long term for at least 10 plus years. Only great companies can pay and increase dividends over the long term. Now, one thing to watch out for is inorganic earnings. So some larger companies basically grow by acquiring smaller companies. And that's fine, but usually in those instances, they're basically trying to buy their way into markets because their legacy business isn't really growing. So we want organic earnings growth. So those are kind of the those are kind of the 5 metrics I use to evaluate dividend sustainability. If you have any other ways you evaluate that, be sure to let me know in the comments below. And if you want to learn more about dividend investing, be sure to check out my website, dividendgrowthmasters.com. I'll also include a link for my newsletter in the description below, where you'll get a ton of information about about dividend investing and building your passive income streams. And if you want to learn more about dividend investing, I have an online course about that. You'll get a step-by-step guide of how to build a dividend portfolio from scratch so you can retire early. So I'll include a link in the description below. Thanks for listening, guys. I'll see you next time.